the stock market Shemozzle, and numerous opportunities. Hello again, it's Martin North from Digital Finance Analytics, world latest post covering finance and property news with a distinctively Australian flavour. Well, I have Tony Locanto with me. Hi, Tony.
Good evening, Martin, and great to be here again for a rare pre-recorded show, because normally I do them live.
Yeah, it's a bit different. We were just saying, isn't it, doing them pre-recorded, but it's pretty much the same, really, just without the questions. Yeah. But it's great to have you back on, and boy, it's been interesting the last few weeks, hasn't it?
It goes with my theme that 2022 has just been the craziest year, and probably in my life, based on markets. We've got crypto going all over the place. We've got fears about people's money. We've got interest rates going up, property starting to tank. And then sadly, another cricket legend died, this time in a car accident, Andrew Simons. So, it's just a crazy year, and there's still 7 and a bit months to go. But look, amongst all the carnage, the craziness, I'm looking for opportunities, and I just stick to my convictions, Martin. And I think rather than focus on areas where not to lose money, I'm going to stick to this area where hopefully viewers can take something away and give it some more thought about what areas of the markets could be next.
Yeah, I think that's quite important, isn't it? Because, it tends to be everything's gloom and doom, or everything's, going roses. The truth is it's much more complicated than that. And even in the midst of a downturn, there are opportunities. And not everything has moved down the same amount. If you take a longer term view, a value view, where is the potential for future opportunity? This actually can create opportunity too.
Yeah, it's an area I've been involved in a long time, for a long time actually. And I guess what I've learned over 24 years of advising is the psychology. And markets, any type of market, is driven largely by psychology. And I view what I do, it's a form of psychological warfare. But, I've been beaten up. It's like stepping in the ring with Tyson Fury. You just can't duck and weave markets. Sometimes you've got to take a few hits. And, rather than focus about what's happening in the property sector, I'm just going to stick to the stock market, put it out there to viewers what I'm doing, what I believe is successful, and just stick to it. And, people can throw tomatoes at me or whatever. But, small companies are out there to become bigger ones. And all I'm doing is trying to find the buggers early.
Absolutely. Yeah. And I've got this vision of, lemmings going from, one to another and sort of going over the cliff. But actually, sometimes if you look the other way, and think about things differently, there are nevertheless, nuggets out there. As you say, the trick is to find them and find them early.
Yeah, I was born with a contrarian mind. I always rooted for the underdog. I actually had a rare perfect 9 in my AFL tipping on the weekend. I just loved the underdogs. And I just look through markets and find unloved companies, the unpopular ones out there, that once they become popular, you sell them. So anyway, I've put together a bit of a slideshow. It's in my usual style, Martin. I'm no Tarek Brooker, who's Tarek's one of the best out there, let's be honest. But anyway, so that's the subject today. I'll just get this. There's the disclaimer. Pretty much this is not personal advice. I don't take into account any of your personal circumstances. I am a licensed investment manager, and I do look after my own clients. So what I'm putting out there, a lot of these stocks I have significant holdings in and have corporate relationships with. So a bit of quick background on me. I've come from a policing background. That's a nice photo of me at half my age. I'm 50. And I fell in love with the stock market. I used to stand outside the stock exchange in Bond Street, Sydney, in full uniform and watched share prices, got to talk to speculators. Then my love affair with the market progressed. I started to write on forums. I started on night shift. I'd have fellow officers test me on about 20 to 30 companies on the ASX. And my role was to try and pick changes in behaviour. I've looked at all the sectors. I looked at charting in about 1995 and quickly dismissed that. I then became a bit of an author. That's my book I wrote 21 years ago. And pretty much tried to write a textbook on speculation. And that fueled a lot of my research into previous bubbles, stock market bubbles, property bubbles, you name it. So that's a little bit about me. I currently am at Alto Capital in Perth, and I look after pretty much 380 mums and dads. And I think what's happened over the years is dealing with thousands of people, dealing through the dot-com bubble, dealing with fear, greed, and stupidity. I've got a decent handle on the psychology of markets, and that's taken me 24 years. And I should make it perfectly clear, for the first 5 years, I lost money hand over fist. I was buying tips out of newspapers, I was buying on rumours, and I was pretty bad at it. And sadly, new entrants into markets are going to cop some pretty hefty lessons, especially considering what we're seeing in the likes of crypto, NFTs, and other markets. So what I'm trying to do is avoid those mistakes. So this is the index. This is the almighty Dow Jones index of 30 companies. That pretty much is the actual elephant in the room. And as you can see from that chart, we've hardly had a correction, really, apart from the COVID meltdown. That's when stocks were getting absolutely smashed. And we can see now it's come back from about 35,000 down to 32. And last night was a pretty lame night. And I have this saying, I know we're not playing Locantro bingo, but this index tends to tiptoe through the tulips. And it dances sideways, and then suddenly we get those 1,000-point down nights. We might get a 900 bounce. But look, the way I see it is, I was watching one of Tariq's videos, his latest, and he was saying what we haven't seen yet is a material decline in earnings. And I think that is a major threat to the market. And whilst this doesn't represent, it's not the S&P 500, it's the first major index that people refer to in the morning before they start looking at the gold price. So I see quite a hefty correction coming. I'm not a chartist. I just think once you get a bout of negative sentiment, selling begets selling. And I think you'll start to see some headlines in due course. The Dow falls below the psychological 30,000 level. And a little bit later in my slideshow, I'll show viewers that are fairly new to the channel how I'm combating that index risk. So that is the elephant in the room. Actually, that elephant is a bloody big one. And I guess a lot of world stock markets react to how that trades. So there's the S&P 500. Not really a massive correction there. You see that it's had a decent trading pattern in a lovely northeasterly direction. You can see the COVID crunch there. So markets, when we went through that scary period in 2020, have actually recovered quite well. And to me, this is hardly a correction. And I see that the broader market is going to go through some difficult times, remembering that we're only at the beginning of the Fed hiking cycle. And I think that's going to reverberate through. I think equities are going to get sold off to some extent and due to greater risk. So again, we've also got earnings risk in the S&P 500. So once you start to see a contraction of earnings, share prices will fall with it, and volumes will start to dry off. So dry up. So that's the S&P 500. Again, there are instruments that you can bet against that, which I have made use of. Here's the Nasdaq. The Nasdaq has been absolutely poleaxed. You can see from that chart, tech stocks have just come completely off the boil. And the funny thing is, though, the key to becoming super wealthy is to list a company that doesn't make profits. I think, you can look at all these major companies. You've got to exclude the likes of Apple, etc. But, the buy now, pay later sector has been carded, and you've got other earnings problems in the likes of Uber, etc. So, the tech stocks, really without PE ratios, you're high flying. And as soon as sentiment turns negative, you get absolutely walloped. And some of these falls are quite frightening. So I still see further weakness in the Nasdaq, even though it's down roughly 25% this year. Here's an index that has certainly taken some of my paper wealth off me. It's the Nasdaq Biotech Index. And again, that has been absolutely thumped. And the selling pressure on a global basis in biotechs has certainly spread to Australia. And I see this is where there's going to be some major opportunities. And I liken some of these small cap biotechs as similar to buying beachfront property in Sydney about 20 years ago. As controversial as that will sound, but individual companies have been caught up in the sector shit show, and that is no more evident than that chart and the Nasdaq chart. So I remain a great believer in the biotech sector, and I just can't believe some of the prices we're looking at now. There's the ASX 200. Again, it's had a bit of a correction, but I still see further downside in the likes of our major resource companies, which have benefited from oil price, from high iron ore prices. Our banking sector has performed quite well. Commonwealth Bank is still over $100. I think it's around $105. Macquarie Bank, which has forged its way up the table, was over $200 a share, now finds itself at 180. I just think once sentiment turns negative, a lot of these major companies will start to see some selling pressure. Some of the bank results, I believe, are the best we're going to see in years. So major headwinds, property, markets, debt, you name it. So I'm bearish on the S&P ASX 200. And again, we haven't really seen the steep declines where you get, 20% puts you in bear market, anything else is referred to as a crash. The gold price, it loves to get towards the 2000 level. Then we have a liquidity event, it gets smashed. The constant chatter about the gold price, calls for 3,000, 5,000, 10,000. I think Harry Dent has a call for $800. It's just something I believe that is a store of wealth. It does protect purchasing power. I use a terrible example that in the early 70s, 700 ounces of gold bought you a house. And these days, 700 ounces of gold will buy you a knockdown in Mount Druitt. So the gold price does maintain purchasing power. If you buy it in the right times, you're also going to get leverage. But I've always found the best upside by playing the gold and silver stocks, silver area sector, comes from actually buying the stocks. So again, a bit of a defensive move. And actually what has shielded the gold price in Australian dollars has been the poleaxing of the Aussie dollar. So the Australian dollar gold price is still around $2,600 an ounce. And you've got companies out there that can have an all-in sustaining cost. So the AISC refers to everything that goes into the cost, not just some of the digging out. So there's quite healthy margins there. And I still believe at some point our gold producers are going to become the next banks that will provide healthy dividend stream. And what really could propel the gold sector would be a lift in the participation rate, because participation rates of the gold sector have been quite low. Obviously, the whole world turned to crypto. Gold was then called a barbaric relic. So, but anyway, I still remain focused on the gold and silver sector in particular. So let's look at the impact of some of these other sectors. Crypto, we had the Luna debacle, a lot of life savings lost, a lot of despair. Bitcoin has undergone a bit of a correction, but there is a little bit of discussion as to the flow-on effect to equities. Like, it's been a market meltdown, it could get worse, but the major impact I see from the crypto fallout will be slowing participation rates in the stock market. I think that a lot of crypto trading in particular has seen the youth of today develop poor financial habits and essentially become gamblers on, it's just like red or black or up or down. So I think, yes, there's going to be a financial impact and it will turn people off markets, but could it break the market? Well, I'm not so sure in that regard. I still see gold and silver, silver in particular, that has been sold off recently as a good way to protect wealth. Silver price has been weak. It did go under $21. So to me, there's numerous opportunities in silver. There's limited listed silver stocks on the ASX. Our gold producers, a lot of them have essentially been cut in half, mainly due to production issues. And also, once the price in US dollars failed to breach $2,000, there has been some selling and a more cautious approach. But if you look down the list, there are quite a good number of gold producers that will always look into exploration and M&A activity, which I think is going to continue in that sector. Uranium price has performed exceptionally well, as you can see by that chart. One of the interesting things was that the uranium stocks got well ahead of themselves. I know a number of my clients that bought the likes of Bannerman around 3 cents, were able to sell out at 8, 9, 10 times the price. We also went into EL8, Elevate, that was trading around 8, 9 cents and actually went into the 70s. And you've got the likes of Paladin and Deep Yellow. So what happened was, based on the Sprott fund and the buying up of uranium, that caused a bit of FOMO, and the stocks certainly did get ahead of themselves. And now, there's certainly been corrections where some uranium stocks have been cut in half. I like to look at small cap companies where I can value them. To me, in a lot of circumstances, the worst thing you can do to a resource is mine the bloody thing. And it's just like putting a ring on it. Can be quite as financially devastating. So yeah, certainly uranium, one to watch, but the FOMO-driven buying has certainly been sucked out of the market along with sentiment. And I think that has extended somewhat to the EV thematic, where I believe lithium and rare earth stocks got well ahead of themselves, and the lithium stocks are correcting. There was some negativity about BHP saying, look, we're not going to join the lithium rush. There's talks of demand going through the roof. But again, once you run into a negative market, the stocks that get ahead of themselves are going to get sold off heavily. And a lot of these stocks are heavily discussed on the forums. And it's all psychological about, you have a share price go over $2 and then suddenly it's trading around $1.50. And it really plays with the mind of speculators thinking, well, I still want to see that share price get to $2. And that psychological game, I believe, is going to play out in the property sector, especially East Coast. And I don't think I need to talk about that too much more. So what I've done is on my own portfolio, I'm going to be straight up. I am a speculator. I love the romance of speculation. I love buying stocks that are going to put money into the ground to find a mine. I will IPO biotech companies that are looking at new treatments, for example, cholesterol and other ailments and better ways of imaging and cancer CAR-T therapies. I just think that really is the essence of being a speculator. And I'll continue to swing whilst I'm playing with a full bag of marbles. But I'm cognizant of the elephant in the room, which is the S&P 500 and the Dow Jones Index. So that is a negatively correlated ETF. It's BBUS. I went in quite heavily again at $8.67. It's trading around $11.30. So do your own research. I don't know your circumstances, but for every percent the S&P 500 falls, you should see 2.25% to 2.75% returns on that. And what you need to remember is that during bear markets, you always get powerful rallies. Like the market might get sold off a couple of thousand points. You might see a quick 1,000-point rebound. So these BBUS, it's going to see 6 to 10% swings on some days. But I still believe that the longer-term trend is certainly down. Based on my speculation, I'm holding about 13% of my total portfolio in the BBUS and the BBOZ. So the BBOZ tracks the Australian market, and I do have some exposure to that. The other negatively correlated ETF is the SNAS, S for Sam, N for Nelly, A for Apple, S for Sam for the Wheel of Fortune fans, which has performed exceptionally well because that was negatively correlated to the Nasdaq, and that's certainly one ETF I wish I bought with the benefit of hindsight. So what I do with new clients, I'll have a talk about their risk profile and say, well, there's a lot of index risk around. I think you should have at least 10% of your speculative portfolio in these ETFs. And one of the advantages I've found is that there's always a liquid market for it. So it doesn't matter how many of these you hold, you can sell them at one price step, normally one price step lower. And that's much easier than trying to sell a speculative stock or a position when there's no buyers. So even though you might be down on paper on some of these, you do have that liquidity. And to me, it's all about opportunity cost. If you can peel off one of these ETFs and buy an undervalued stock that triples, I think it's served its purpose. So hence why, as I said, about 13% of my portfolio is in these. And it's kind of a defensive strategy as well. It's not going to be for everyone, but anyway, that's the way I've gone personally. Now, this is an example of an ETF it's been more than smashed. It's the Cathie Wood Innovation ETF. And as you can see that the Ds are dividends along the way. But this just shows, this is the Nasdaq decline on steroids. And it shows the risks associated with buying companies that are trading on hot air, that don't even have a PE ratio. And I believe I was reading that she's gone in and tried to pick the bottom of Coinbase as well. So this is probably, for those that have got access to it, one worth keeping an eye. It's well worth keeping an eye on, because this correction could get even more savage. And, to some extent, these beaten up tech stocks, well, the decent ones anyway, should see a bit of a recovery. But, that to me, the world went crazy for tech. And then suddenly, once you have, risk off again, you can see what happens there. So an interesting perspective, and that's probably one of the most volatile ETFs, the ARK one. Now, I have the Campfire Example. I often send that out to clients. So pretty much the Campfire, let's think that's the company just getting on with their business. Yeah, you see the man playing the acoustic guitar, they're having a bit of a drink, happy days. Then suddenly the crowd goes absolutely wild and it's a riot. So I see examples all the time where shareholders turn against the company, a company that's working towards clinical trials, working towards developing a mine, that are just getting on with their business. And then suddenly, you wish they came out with an announcement in something else to drive the share price. So, that I'm talking about 500 plus drops on the Dow Jones. Well, I think we're going to see more of these 1,000-point nights down, and exactly that. The crowd will go wild, because there's always diligent small companies doing their best to add value, but people just don't want to know about it. And I have this saying with my clients is the good news will keep getting banked, and eventually it will be rewarded. But when there's fear in the market, when there's panic selling, it's just going to take a bit of time. And what I love about what I do is market psychology. That's one of the companies I recently floated, Morona Metals. So I threw a heap of my own money plus my clients in at 20 cents. And we had a really bad night on the Dow Jones. And then suddenly a large buyer appears at 32.5 cents. And what happens is people are just gripped by fear. They're thinking that buyer doesn't know what they're doing. So they immediately rush to get out of their stock. And the stock has continued on. But I'm actually just wondering as to investors' threshold, if they can handle 500-600 points off the Dow, if 1,000 points pushes them over the edge. And you've got to look at that elephant again, for your longer term investment, because this, I know it's a penny stock, but it's actually an investment, as I'll get to later. But the elephant in the room really makes us do things we don't really want to do. So anyway, I've seen that in the market. I've seen stocks that they're a bit of an ecosystem, an economy where, once people reach their threshold of pain, they'll sell. Smart money will back off, and you get the 20-30% corrections. And sadly, that's going to occur in a lot more sectors, than the stock market. So, I think if you're in the small caps, you do get beaten up, but again, it all gets back to psychology. And, you're going to still see major moves in the much larger companies. So what I do is I stick to my 20 companies. They are all small companies. I think will become much larger ones. They're all extremely high risk. I'll just run through a couple. I'm not going to mention them all. Morona Metals, it's been listed about 2.5 weeks. We chucked about $2 million at it. They are hopefully expanding a lead, silver, copper, gold deposit in North Queensland. And it was undervalued. It was a good deal for shareholders. We got our shares at 20 cents. We got piggyback options, meaning you get one option at 30 cents. And if you exercise that, you get another option at 60 cents. That is all going to boil down to the rotary lie detector. If that resource expands, I expect some decent upside. And interestingly, Oz Minerals took an option of Havilar's copper deposit in South Australia. They're going to do their due diligence and could pay up to $205 million for it. So what I see is more M&A activity in even the base metals sector of the market. And Maronan is a potential tier one asset. Sure, it's extremely risky, but it's something I regard as more than a penny stock. Narada are developing the cholesterol drug. I know I talk about it a lot, but they've had a manufacturing delay in Shanghai. Today, they announced that they're going to get granted a European patent on the inhibitor. So that's all about reducing LDL cholesterol. It's shown excellent results in an engineered mice model. And you know, on that delay in Shanghai, the shares got recently sold down to 15.5 cents. They closed at 20 cents today. It is one of my largest positions on a personal basis. Red Metal owns 50% of Maronan. Well worth doing your research on that. So what happens when a company owns a large chunk of another? You calculate the market cap, and you'll see that a lot of these companies will trade at an ongoing discount. And that's just a function of the market. You rarely see that rewarded. But again, Red Metal is a good company in its own right that owns 50% of Maronan. So again, I know the markets and a lot of speculators are disinterested in these opportunities. Once risk comes back on, once people start to become excited about resources, we get a bit of M&A activity. I think that will come to the fore. The other one worth mentioning is Far East Gold. I floated that. I assisted in the IPO a couple of months ago. That's in Indonesia. It still hasn't stopped it from doubling. They're looking at a ginormous copper gold system in Indonesia. Again, extremely high risk, but the IPO did exceptionally well. First class management team, so we're happy to have backed that one. A bit of bad news for us, Ultimate. We went pretty hard into it. It's actually a zinc deposit in northern Italy that was looking like becoming a much bigger resource close to zinc smelters that need a great feed. The stock, was trading down around 7.2 cents, and then suddenly a 9.5 cent off-market offer came in for it. And I was quite disappointed to have to ring clients and say, look, we've been cut off at the knees. All our upside now, you know, it's just evaporated, because what lowball takeover offers do is not only do they put a floor under your price, the bloody things also put a ceiling on it. So that is a fantastic company. I hope, you know, management are going to put up a fight. I think the bidders at 9.5 have to go higher. But sadly, I'm going to lose one of the best emerging mining companies on the market. But that's what happens from time to time. And I just hope, you know, a major doesn't go anywhere near Maronan. Hopefully we get to drill that deposit in over coming months and get full value for it. And that's what speculation is all about. And it's the old, you know, drill deep, hope to find a mine. And shareholders are rewarded, because when you find a mine, it creates income, it creates tax, and it creates jobs. It's just a matter of which government's going to take the most tax, I guess. Not much else really to mention. I have been buying Chimeric and Radiopharm. These are Paul Hopper companies. Paul was at the helm of Viralytics when it was taken over for $500 million. Chimeric are involved in CAR-T cancer therapy in the US. That's already showing fantastic signs, and it's put some patients, in one patient in particular, has had a very good lifespan and is somewhat in remission. Always there's a risk. Now, that CAR-T therapy is for those with severe GBM. So it's a hideous disease, but they're working on it. That stock, again, has been absolutely crunched from mid-20s and is now trading at 11.5, 12 cents. They recently raised money at 17 cents a share, so we're well below that. And Radiopharm just highlights the poor performance of the biotech sector. It listed at 60 cents not that long ago and is now trading around 19.5 cents. I nominated 29 cents as my bottom. Since then, I've been forced to buy it at every price point down. It has been an expensive hobby. I did collect some shares at 18 cents. Hopefully, I'll take that contract note to Officeworks to get laminated and straight to the pool room. So, yeah, I'm not going to mention every company. Actually, I will mention one more. Pac Gold, we got involved at 25 cents. Shares ran to $1. They're about to drill a massive gold system in the Alice River Gold Project in North Queensland. We just assisted with a capital raise at 63 cents. Those shares have only been issued over the last couple of days. I think you can buy that one for about 62 cents a share. But from my experience, these gold explorers with a tight capital structure provide multiple upside, and we saw that from the 25 cent IPO to a high of $1. But again, with speculative stocks, those that fly too high often come back, and the corrections are quite nasty, but no risk, no reward as far as I look at it. And something a little bit out of left field, I had another WTF moment in the cinema. I think the first one I really had was District 9, but I went with my partner to see Everything Everywhere All at Once. And it's very rare to have a movie that makes you think. I don't know. I see myself as quite a compassionate person, but it just made me, I guess, have my feelings reiterated. And it's just interesting to see what people could do in parallel universes where life can take you. It's just something I've never thought I'd see, but it's really frantic, and you do need to take a bit of a break from it at times. It is overlong, but I just think it's got those concepts. There's a couple of scenes in there where I know most of the audience were choking back tears. And I know, Martin, we've spoken about Don't Look Up, but this is something, it's a little bit out of the ordinary. And I guess it's a good summary of what's happening in the world at the moment, because we've got a bit of everything. And I just hope, hopefully 2022 is going to give us a bit of a respite. So anyway, that's it.
Yeah, thanks, Tony. Very interesting, and congratulations on going through that really well. And the film that you've mentioned there, another very interesting one. So definitely worth a watch.
Yeah.
And I think the message, listening to what you're saying, is that you need to be level-headed about what's going on, right? Because we are going to see probably further falls on the main indices, and what's interesting, if you look at, for example, in the Nasdaq. Some of the most overvalued stocks are actually the ones that have fallen the most. So they're not all falling the same amount, right? So even within one index, there's a lot of chaos going on there. But if you assume rates are going to go up further, as they probably will, then almost certainly those are going to go down further. So that's the first factor. Then the second factor that you say, well, but despite that, there is still stuff to think about. So it's not about necessarily of sitting on the sidelines and doing absolutely nothing, but you have to think differently about the problem. And I think that's what I find so interesting when I listen to you and when I chat with you about this.
Yeah. People say, well, why don't you wait for the end of the bear market? Well, the problem is by that time I could move into a lifestyle village. And, I've seen this, what I've done is I just developed a thirst for reading, speculation, hanging outside the stock market, having massive gold discoveries, dealing with people's emotions every day. I mean, life is just too short not to have a go. And what I've noticed is that corrections are nasty. They do cause companies to have to raise money at lower prices. And often the fear of a capital raising is actually worse than the event itself. But if you've got good fundamentals and you get through your phases, your drilling is successful, mining is successful, and a lot of drugs these days, the companies are so small, they only really need to get them through phase 1 or early phase 2A, and majors will come knocking because the world is awash with major biotech companies looking to buy out these miners. So there's always going to be that. I mentioned the Oz Minerals corporate activity today. There's no way known to man I'd expect our zinc company in northern Italy to attract a takeover bid, because normally takeover bids are ego-driven and they occur at stupid valuations. Look at Elon Musk. No, that's not, sorry, that's not very funny, but I don't think he should have the right to tweet about his mood changes on a $54 billion takeover.
Yep.
So, but, I like what I do. It's not for everyone, but you've just got to work it. It's like a two-speed portfolio. My mining stocks are doing exceptionally well, and my biotechs are just lifting their head off the canvas. But, it's like an AFL team where you're going to have a handful of good performers and everyone else isn't doing much. So as I keep saying, you need to be aware that the pressure is to the downside. I cannot see anything triggering a major rally. Maybe if we see a bit of a resolution to the Russia and Ukraine situation, but you do have to be fearful. Something to fear is, in fact, going short during bear markets, because the rallies can actually wipe you out, because there are powerful moves in both directions. So, it's certainly a world awash with, every emotion.
Absolutely. And of course, the volatility has been more extreme than we've seen for a long, long time, although the VIX is not quite as high as it was some time back. But it is an object lesson in trying to pick the bottom, and, dead cat bounces, bottoms, and all those sorts of things. And it's very interesting how all the market speculators have their opinion about, oh, this is it this time, or it's not, right? I actually think, Tony, that the answer is nobody knows yet, but the gravity has a significant role to play here, right? In terms of prices will probably go down further.
I think one important point is that major indices can correct from any level.
Mm.
Yeah, sure, the Dow Jones got to over 35,000, and it's due for a fall. But we could have the Dow Jones at 20,000, and it still could easily fall 5,000 points, or a decent percentage. So markets tend to overshoot in both directions. And if you sit on the sidelines with cash, I hate that saying, you're going to miss out. But the good thing is about the small cap stocks is there's always companies that are going to develop into major companies. And one of the risks that I see is that a lot of new traders have been jumping on bandwagons. They're following themes. They're getting involved in stocks that become cult-like in nature. But I remember vividly the day the Nasdaq died, we didn't really have any bandwagons or themes till the great uranium bubble of 2005. So we could go through this period of nothingness. People will start to find other ways to punt. I mean, there's 13,000 shit coins out there. And people, welcome to trade it, but it's not getting any of my money. So, we could go flat. My volumes have started to dry up as well, but you need to look outside of traditional assets such as property and say, well, okay, what's next? And my view is that I continue on my small cap way. We have some big wins, we get beaten up, some of them drop 50% plus, but we soldier on. And I'll do this, as I said, till I fall off the chair.
Tremendous. Well, Tony, thank you very much. That was a very informative and I think very timely discussion tonight. So really appreciate it. We'll pick up the conversation a few weeks down the track again and see where it ends up, right? But I think the net conclusion is it ain't going to be simple.
No, it never is. Absolute pleasure for having me, Martin, as usual.
See you later, Tony. Thanks very much for that. Take care. Bye-bye.